Welcome. It's Tuesday morning on the floor of the New York Stock Exchange. We are here with the Mark Otto, that is a managing director at Streicher Company. Mark, thank you so much for being with us again.
Thanks for having me back.
So, Mark, we are seeing the indexes right now in the red after two good sessions. Of course, we are looking at Europe today. The estimates for the growth GDP has been revised down, but of course, we're also looking at the economy here. Still, not stellar news.
Yeah, it seems as though growth forecasts for the Eurozone certainly took the headlines, and that's why futures are down this morning. I think there's a lot going on this week. The market's still, up near all-time highs, so people are a bit skittish. Perhaps there's some profits being taken off the table. However, over the past couple of months, any dip has been a buying opportunity, so we'll have to see going forward what happens.
And also, you were saying after a long run, and apparently historically, we might be heading for a very good November and December. I'm saying historically because since 1928, the numbers really indicate that after a big gain, over 10% from January to October, we might see very positive 2 months. That will really tell us that this is just a pause, is a break, and there is no reason, no other catalyst that actually can stop this rally right now.
Yeah, that prediction comes to fruition. The S&P 500 will certainly breach 1,800. I think the projections would land at about 1,820. So, between now and the end of the year, there's not many hurdles. It's just Q4 earnings, and anything the Fed actually may do between now and then. Now, this week, there's a Fed speaker speaking every day of the week practically about a different topic.
And confusing us, if I can say that.
Yes, forward-looking guidance, I think, is out the window. However, there's certainly going to be some knee-jerk reactions in the market. It seems though every algorithm in the world is actually fixated on what they're saying. So, you can't just discredit it. The market will probably react to it. There's actually 3 Fed speakers speaking Friday, along with the macroeconomic data that's coming out as well.
And Bernanke too.
Yes, absolutely. So, this week is really going to be all about the non-farm payrolls coming out on Friday. 125,000 is the number they're expecting. The last number was 148,000, and then the unemployment rate is anticipated to be 7.3 from 7.2.
And the ADP number already, not that they have been, relevant most of the times, but they are already anticipating a very weak number. So they will help the market again to just estimate and no tapering until next year.
Yeah, I mean, there's 3 options that most people I speak to are talking about. It's either March, June, or add stimulus are the 3 options I'm hearing. So, no one's even talking about it this year.
So Q infinity might be an option.
Absolutely. Yeah, the only other things that are going on, obviously on Thursday, we're going to have the rate meeting for Europe. So, there's basically 3 options that can go there. There could be a cut, which more than likely isn't going to happen, but we'll see. They could add stimulus, or Draghi could actually get out and temper the market with an excellent conversation. So we've actually seen that happen before as well.
We have speculations about excellent conversation. I mean, we have speculation that actually Draghi might prepare the market about stimulus.
Yep. Nowadays, it's all about tempering the market with words. So they definitely have swayed the markets. So, we'll have to pay attention to that on Thursday. Along with what's going on here Friday, 3 Fed speakers, including Bernanke, the big wind up with macro data. This weekend is the 3rd plenum meeting for China. So China is actually going to be making some policies for long term for restructuring in the Chinese economy. So a couple of highlights that I've looked at are they may let interest rates be more market based. They may loosen capital controls, and one expectation that I would love to see is for them to loosen up on the housing registration, which would actually benefit migrant workers in China. So 2 of the policies that would benefit from that are urbanization from China, having people come in from the fields into the cities, making more money. As a result of that, domestic consumption may be boosted off that. So it may be a big change.
And that's actually the government aim right now, to boost the internal consumption.
Yeah, they're trying to get away from being dependent on exports, particularly what's going on with the world economy.
Now let's come back here at the New York Stock Exchange. It's a big week. We are not talking about just, the Twitter IPO on Thursday, widely expected, but also we have more and more IPOs. We have, I think, if I'm not mistaken, around 15, 16 IPOs in total this week, plus secondary offering. So it's a busy week here. That means that we are taking really advantage of what the market is doing right now?
I think it's not only for U.S.-based companies that want to come public before the end of the year. We are seeing international companies, particularly out of China, start to actually come to IPO as well. That probably has to do with the timing of the market. We are at all-time highs. If you look at the hurdles in the near future, more than likely, the government's funded through the middle of January. We can borrow until February 7th, and there's no talk of unwind until really March. So they want to get in under the wire. More than likely is what's happening. They want to join in on this rally before the end of the year, particularly if this Bloomberg data comes out and the market's going to rally to 1,800 on the S&P.
Perfect timing, I will say. So you're going to be very busy, Mark?
Hopefully, yes. We would all love to be busy between now and the end of the year with a pickup in volume.
Perfect. Thank you very much, Mark. Oh, before we say goodbye, can you give me some numbers for the S&P 500, please?
Sure. Resistance from here is 1765 and 1770. Support from here is 1757 and 1752.
Thank you, Mark, and have a great week.
Thank you.
And thank you for watching.